All right, we got quite a group. I think we can get started here.
Yeah, sure. Let's do it.
Yeah. All right. I'll lead things off here, I guess. So salam alaikum, everyone. Thank you for coming out today. I know we can't see you physically, but we can feel your presence virtually, and that's all that matters this year at least. So yeah, my name is Shamil, and I'm a financial advisor at ShariaPortfolio Canada. I'm actually located in Vancouver. So if there's anyone from Vancouver here, hello. Yeah, so the main objective of today is to provide you with an informational session about kind of going over the types of accounts in terms of the RRSP versus the TFSA, and kind of helping you make the right choice and find what the better fit for you is. So let's get into it here. So let's try to move to the next slide here. Perfect. So a quick disclaimer before we get started. Everything today is for educational purposes. So we would recommend that before making any decisions, you speak with your own financial advisor. So yeah, that's a quick disclaimer. So the agenda for today. So the agenda, we're going to start off with a welcome, which we just did. Really nice to meet everyone. Then we're going to talk about ShariaPortfolio Canada, kind of what we are, how long we've been around. Then we're going to go over the value of money. Next, we're going to talk about the main course, which is the RRSP versus the TFSA. Next, we're going to go over the best fit for you. And then lastly, any questions and answers. We do have a Q&A chat, so feel free to put any questions you may have into that chat. And myself and Nadeem will be able to answer it throughout the presentation and at the end. So without further ado, let me kick it off to Nadeem here. So let me give Nadeem a nice little intro. So Nadeem began his career with Oppenheimer & Co., which is a Wall Street firm. And he actually started over there. And in 2002, he came back to Canada. And when he came back to Canada, he had roles in private wealth management firms such as HSBC, Canaccord, RBC, and he joined us at ShariaPortfolio in 2019. Nadeem graduated from Concordia University with a Bachelor of Commerce in Finance and holds a CFA designation. And Nadeem has over 20 years of experience, and really, I know he's really excited to go over all the different types of accounts today. So Nadeem, take it away.
Thank you. Nadeem. Assalamu alaikum, everyone. Thanks again for joining us. As Shamil said, my name is Nadeem. Some of you have heard and known me from before, and for the newcomers, welcome. So I'm just going to dive right into it. For those of you who are new to the firm, ShariaPortfolio, this is a brief background on the firm itself. The parent company, ShariaPortfolio, got started really in 2003 by our founder, Noshad Virji, who at that time, the company was called Virji Investments. And at that time, he was operating only in 5 states, essentially managing, family and friends' money. But, alhamdulillah, the business did start to grow. And 2014 is where we kind of hit our pivotal moment. And really, the growth really started there at that point, where we got into about 26 states. And we got registered with the SEC as a investment advisory firm. And, with that growth, of course, we being Muslim Canadians here, we're alhamdulillah, we're a growing and a vibrant community. And that obviously caused a demand for Sharia compliant investing. And so with that, in 2017, ShariaPortfolio started to kick the tires on coming into Canada, and which eventually in 2019 we really kind of got our registration up and running. We actually got registered in January of 2020, so 2019, 2020 is kind of where we officially became a registered portfolio management firm. We're currently licensed in Ontario, British Columbia, Alberta, and I believe Manitoba now too. So and some of the other exciting things our parent companies have done. We have a sister company called SP Funds, which is the company that runs our ETF and our fund business. And recently, last year we launched, I should say 2019 December, we launched 2 ETFs, the SPUS and the SPSK. And more recently, in December of 2020, we launched the very first Sharia compliant real estate investment trust ETF. And so we were super excited about that. And we also rang the bell at the New York Stock Exchange in 2020. So super excited to be a part of this company, and look forward to it. So now getting into the topic of the day, which is RRSPs, TFSAs. Before we get into that, just some quick math here. I think we probably have a wide variety of attendees, some new, some experience. So this is for some people, this might be something they already know, but for the newcomers, it's also a good refresher, right? So the point of this exercise really is, when we have money and when we're in an environment where there's inflation and the cost of living continues to rise, having your money work for you is very important. Right now, typically, again, this is just for illustrative purposes. We're not advocates of riba. That is obviously haram, and we don't endorse that. But just for math purposes, if you just left your money at the bank, and I arbitrarily picked a number here and said, okay, 10,000, and you just, even if you saved 150 a month, what would that mean over the course of 20 years or so? And at a 2% rate of return, you're seeing that your 10,000 eventually goes to 59,000. Now that might sound okay, but you're not factoring in the time value of money. So the importance of this exercise here is the next slide, which is, if, for example, you actually invested that money and grew that money and also contributed to that money, what would be the big change? And you can see that the change really is exponential, where you start off with 10, you're blindly investing $150 every month, and all of a sudden, if the money grows at 9%, now the S&P 500 is actually annual average is about 9.9%. So if, let's just say, you had invested into the market and that money was growing on an average rate of about 9%, you can see the exponential growth of the money that you've invested in its savings. So again, just a quick exercise. This is just for illustrative purposes. We're not here to guarantee you 9% or 2%, whatever, but this is just more of a theoretical kind of discussion as far as getting your money to work for you, right? So, as Muslims, I think it's incumbent upon us to not only take care of yourself, but take care of your family. And I think this is obviously a very important discussion we're going to have today. So first and foremost, what is an RRSP, right? I think, I've been in this as long as I've been doing this, and, 20 years. It's amazing because a lot of people still don't know what it is exactly. So we're gonna go through that in this discussion, and we're also going to talk about the TFSA and the pros and cons of both, right? But basically, what an RRSP is really called a registered retirement savings plan. It's a government approved account that allows Canadians to plan for retirement. So pretty much the word is in the meaning, and it is what it is, which is it's a retirement savings plan. It was introduced back in 1957, so it's a very old plan. It's probably the most popular plan amongst Canadians. And this is the one big thing that you have to keep in mind. This is not an investment product that you buy. And it's not just, the new Canadians, even old Canadians who have, been here for many, many years and generations. They'll even use the term that I have to buy into my RRSP. An RRSP really is a type of, it's an account. And the metaphor that I like to use is it's like a pot, right? And what you put in it, the investments, those are the ingredients. So there's a different, so when people come to me and some Muslims have this belief that all RRSPs are haram because I went to my bank and they told me to invest into it and they were going to sell me a GIC. Automatically they have this thinking that, oh my God, it's haram. That's not the case. The unfortunate part, and again, I've worked at the bank, so sometimes I don't mean to say anything. Well, I'll say what it is that the banks are very powerful in Canada, and typically, if you walked into a bank branch and if they have an RRSP campaign running, it's almost automatic that they say make a contribution and put it into a GIC. And unfortunately, that sales pitch, that marketing campaign becomes almost the definition of the RRSP, especially for the Muslim community. So making it one thing clear that RRSP is not an investment. It's a type of an account. It's like a pot, and what you put into it, the investments, those are the ingredients. And those ingredients are what makes it halal or haram. And that's what we're here to do. So first of all, what type of RSPs are out there? So these are three basic types of RSPs. There are other types of registered plans out there, but for the topic of this discussion, we're gonna stick with RSPs. But if you have any questions on other registered plans that you might be a part of or familiar with, you can definitely put that in the Q&A. But for the most part, these are the most popular one. Number one is just the individual self-directed RSP. This is basically, it's an account, it's under your name. You can, set it up yourself with either, an advisor or a firm like us, or you can even do it on your own. But, the key thing about this is that the investment and the tax advantages actually belong to you, right? So it is what it is, which is it's self-directed, it's yours. The advantage is under your name and the investments are yours. Okay. And when I say it can be managed, right? And that's what we do here at ShariaPortfolio, is that we do manage these accounts for you. And of course, if you've been in our previous seminars, webinars, you know that, we do this in a Sharia compliant way, right? The second type of RSP account is what's called a spousal RSP. And for the spousal RSP, this is where you're registered in the name of your spouse or your common law partner, right? So meaning to say, in a situation like this, is you have one party who, I'll use the case of, say, a husband and a wife. Let's just say in this case, one of the parties is a high income earner and the other one is a stay at home. The spouse that earns the high income opens an account for the stay at home spouse. And in that case, what ends up happening is the contributor, which is the high income earner, makes the contribution to the spouse's name, and the investments actually belong to the spouse, the stay-at-home spouse. And in that case, the high income earner actually gets the tax benefit, whereas the investments actually do belong to the stay-at-home spouse. So, similar to the individual and the self-directed RSP, this also can be managed by either yourself or an advisor like us. But the key thing here is with the spousal RSP, it allows you to kind of split the income, so to speak, where one individual is making a lot of money to take advantage of the tax benefit, the other one cannot. But so the assets kind of pass along over to the low income earning spouse. The third one is the group RSP. Now, some of you who are working, especially for big companies, might have a plan such as this, where the plan is actually offered through your employer. And, this is actually something that companies use to kind of entice employers and retain their employees to say, look, if you stay with us, you're going to have a registered plan, we're going to contribute to it, and so forth, right? So the account is registered under your name, but it's registered through the employer. And, the benefit for something like this is you are contributing to the plan, but at the same time, your employer, and I would say in most cases, the employer will either add or match that contribution. So, with this type of a setup, however, all the employee accounts are at one firm. And, typically it tends to be, one of the big banks or one of the insurance companies. And in this case, what's happening is the investment options are kind of limited to whatever that financial institution has in their lineup. So unlike the individual, unlike the spousal, where you can actually have the ability to kind of manage it on your own, or have a third-party advisor manage it for you, with the group RSP, it's kind of limited to that financial institution that holds that, right? So again, these are your three basic types of RSP. Some of the advantages of having an RSP, of course, first and foremost is tax deductible contribution. You're putting money in pre-tax and you get a tax refund. So to simplify this, let's just say if you made $50,000 for the year and you put $10,000 into your RSP, you were taxed on $50,000. But when you put $10,000 in, essentially what ends up happening is your $50,000 now goes down to 40. So the government now is taxing you on 40. And then that kind of becomes your tax credit, right? So if the government charged you taxes on 50, guess what? You made an RSP contribution and they should have charged you at 40. So now you get that tax refund. Number two is the tax sheltered compounding. So basically this money, once you put the money into the RSP, that money is growing tax-free, or I should say, it's going tax-free, really. So all the capital gains, the interest, the income that's being generated in this portfolio, that accumulates, and you're not paying any taxes on that for that year. You're actually deferring the tax, and that's the whole purpose of the RSP, is that currently you're working, you're most likely probably in a average to above average tax bracket. And so when you accumulate these funds, and these funds are growing at the time of retirement, when you are no longer working, you're actually withdrawing these funds at a lower rate, and then that kind of becomes your income, right? Another advantage is you can use this, for your first time, for your home buyers plan. So if you're in the market to buy your home for the first time, you can actually take up to $35,000 per account, for the down payment of your house. And that's kind of the one of two exceptions, actually. The second exception, which is not on the slide, is you can actually use it also for learning purposes. So for example, if you decide to go back to university and you have your RSP, you can actually use the money there. However, you do need to pay that money back in, I think, 15 years is kind of the time that they give you, right? Other benefits, there are benefits, estate benefits, such as it bypasses probate and any legal claims. So meaning to say, if you have an RSP, and God forbid, if you were to pass and you have assigned a beneficiary on your RSP, it bypasses all the probate and it goes to the person that you've designated the beneficiary to. Okay. Unused contribution limits are cumulative and can be timed. So this is actually pretty cool in the sense that you don't, just because you have an RSP contribution amount limit, for example, when you do your taxes, your accountant or your notice of assessment will tell you that this is how much you can put in your RSP. You don't have to use it in that year. You can choose to kind of, prolong it and use it the next year. And the reason why I think it's timely is that if you know, for example, that you didn't make a lot of money this year, but you will next year, it can be quite advantageous, right? So I guess a perfect example would be somebody who's on mat leave, actually, right? Where, that individual for that year did not, was on mat leave, so their income obviously would reduce, but they do plan on going back to work, let's just say the following year, and they know that, they're going to be making the same amount or whatever. So they can actually decide, I'm not going to put anything this year, but I'll defer it next year, and that way I can get a bigger tax credit for that. And last but not least, there's actually creditor protection on this, in the sense that, legally, if you are in a situation where somebody's coming after your assets, they cannot touch your RSP account. They can go after other accounts, but they will, the RSP account is one account that actually is protected from that. So some of the disadvantages here, again, accessing the funds prior to retirement, they have tax consequences. Again, the government's giving you a tax credit. The purpose is retirement. If you're taking money out and it's not for, buying a home or going back to school, the government will say, okay, wait, hold up here. We're going to take our money first, and then we'll see what you get. So there's withholding taxes off the bat, number one, and number two, it counts as your income, and so you are going to pay tax on that. Upon retirement, withdrawal from RSP is taxed as income. So, at some point, the government gave you a tax credit. The government will want that tax back. So, it's only a matter of time till this money is taxed, and it is taxed when the RSP gets. So I use the term RRIF here, and RRIF is just it stands for Registered Retirement Income Fund, and all it really is your RSP becomes converted into an income fund, and that means that you can now start withdrawing money because you've entered retirement. Depending on the situation, it might not make sense, right? So in other words, you could have an RSP, but if your spouse, for example, is a part of a pension plan and they have a really good pension plan, or like with a government or something, maybe that might not make sense for you guys. It might not be the most ideal situation, because at this, what can happen is in your retirement years, your income could be higher than expected, right? And then in other words, now you're no longer at a low tax. You might actually be at a pretty high tax. So meaning to say, you have to kind of take into account, the household income and what that might mean in your retirement age, right? It's not suitable for a short or midterm goal. It does not serve as a good emergency fund. Like I said, there's tax consequences behind that. So the intention really has to kind of be explicit. This money is for retirement, right? Otherwise, I mean, the home buyer one is the other one, but 90% of the time we're talking about, retirement. And the annual contribution limit. So, there is a limit to how much you can put. It's typically on an annual basis, if it's 18% of your income. Again, that's cumulative, right? If you're not using it, it does add up. But there is a cap on that. So it's 18% of your income or a maximum of 27,830. That's what the max is for this year. I mean, this is, I guess, a good problem to have in the sense that if you are if you're making a lot of money, if you're making, over say, $400,000, $500,000, then the benefits of having an RSP are kind of somewhat, restricted, I guess you could say. But again, a disadvantage, but a good disadvantage to have, I guess, for a lot of people. So now jumping onto the TFSA, okay. This is also a government-approved account that allows Canadians to save up for any type of goal. So it's not specific to retirement. This could be anything. It's relatively new. It was introduced in 2009, and it's available to all Canadians over the age of all Canadian residents, over the age of 18. And again, similar to a RSP, this is not a product, that you buy. The metaphor that I use, same thing, pot and the ingredients, no different than an RSP. So some of the advantages of the TFSA, and is that number one, the savings, they grow tax-free throughout the lifetime. So you're not taxed on any capital gains, interest, or dividends. However, there is one caveat, and that is that any investments that have a U.S. source of income, whether it's dividend, like a U.S. stock, for example, that pays a dividend, or let's just say a U.S. bond that's paying, a fixed income cash flow, that is subject to a withholding tax, and that's something that you don't get back. So the withholding tax typically is about 15 or 20%, 15 or 30%, depending on the source. So that's something that, you can't claim that back. Normally in a non-registered account, you can, but something to kind of keep in mind. So we at ShariaPortfolio, we're aware of this. And when it comes to tax-free savings account, we try to navigate through this, taking this factor into consideration. There's flexibility to withdraw at any time, tax-free. So when you put the money in, and hopefully that money grows, at any time you can take that out, and there's no tax, consequences for that. And at the same time, you have the ability to not just open it for yourself, but you can also contribute it for your wife. And so you're actually having two accounts, and you have some flexibility there. Similar to the RSP, there's also estate benefits with the tax-free savings account as well. There's no tax on death. So in other words, if God forbid you were to pass and it goes to the surviving party, any growth in that income, it's not subject to tax, and it does bypass probate. So unused contribution limits are cumulative. So right now the annual limit is $6,000 for the TFSA. But if you've never opened a TFSA account before, you can actually go back till you were a resident of Canada and you were 18 years old, and you can kind of add that up. Now, the best thing to do is probably go to CRA's website and just kind of, you can find what your TFSA contribution limit is, right? There's no impact on to government benefits. So like I explained with the RSP, that one of the disadvantages where when you start withdrawing from the RSP, it counts as your income. So if that income is a little too high, then it could kind of take away some of the government benefits. In the TFSA case, that's not the case. So for people who are elderly and in their retirement, we're talking about old age security, guaranteed income supplement, child tax benefits. So, if you're above a certain income, you might not be entitled to those benefits. Whereas with the tax-free savings account, right, any money that you're withdrawing from the tax-free savings account won't hurt you when it comes to these benefits. So some of the disadvantages of the TFSA, and I don't really think they're disadvantages. I don't like, I don't think they're deal breakers per se, but something that you can say has, where the TFSA has limits, right? So number one, contributions are not tax deductible. So unlike the RSP, where when you put money in, you're getting a tax benefit. In this case, this is after tax money, so you're not getting a benefit, so to speak, by putting the money into it. The annual contribution limit is limited to 6,000 per year. Of course, it is cumulative, which is I guess a good thing. But unlike the RSP, where you can put a maximum of 27,000 plus 27,830, or the TFSA is somewhat limited if you're in that category where you can put a lot of money, right? There's no creditor protection, so unlike the RSP, where there was with the TFSA, if you're in a situation where somebody is coming after you for your assets through a lawsuit or whatever, the TFSA is one of those accounts that they can actually claim on. And last but not least, is it's not recognized by the IRS. So that's the thing, is that for we might have a small amount of people on this who are what's deemed to be a U.S. person. So that could be somebody who is a dual citizen. They're a U.S. citizen and they're a Canadian citizen, but they live in Canada. It doesn't matter. The IRS still looks at you as a U.S. citizen. So, we kind of discourage anybody who has an American citizen or even a green card to not open a tax-free savings account, because again, the IRS does not recognize the TFSA. So that means that if you're an American and you're earning money in a quote unquote a tax-free account, they will actually not come after you, but that's why the withholding tax is what it is. And so, you do have to file with the IRS every year. So they don't recognize the benefits of the TFSA. So that's why it will be subject to tax. Whereas with an RSP, if you've worked in Canada, you've lived in Canada, and you've contributed to the RSP, the IRS does recognize that, and you are allowed to, maintain that RSP account. So, having said that, what is the best fit for you? Ultimately, it all depends on your individual situation, but there are some factors to consider, right? So number one, right, as a general rule of thumb, if you have to take a look at your income and your tax bracket, but as a general rule of thumb, if you are, let's just say if you are not making as much money, but you think that down the road, you are going to make a whole lot more, it might be better that you start off with the TFSA now. And then when you get to, that period in your life when you are making a lot of money, then you can really kind of reap the rewards of an RSP account, right? So there is this balance. I mean, as far as, should I contribute to my TFSA? Should I contribute to my RSP? I think it does come back to the tax level, but we obviously kind of encourage both. But again, something to consider: short-term versus long-term horizon. If you are of the opinion that you might have another goal, and you're not, like, for example, whether it's buying a home or traveling or whatever, a TFSA might actually be, a more ideal situation, right? Whereas with an RSP, it's pretty explicit. The money is long-term and it's for retirement. Expected income during retirement. So again, with somebody who, let's just say, is expecting to earn for somebody who can see that, in my retirement years, I think our income levels is still going to be high, whether it's, through their spouse, or whether it's, because they have other income generating, businesses or whatever. In that case situation, it might not make sense, because what ends up happening is, yes, you can grow that money tax-free, you can take out that money tax-free, but number one, you're still in a high income tax bracket. And number two, some of the government benefits that you're entitled to, like the old age security, the GIS, and you might not be able to get that because you don't qualify for that. And then in some cases, so again, something to keep in mind, of course. Of course, if you're a U.S. citizen, like I said, don't open up a tax-free. We encourage you not to open up a tax-free savings account, and stick with the RRSP plan. So ultimately, we do recommend using both accounts. It just kind of, use both accounts for your long-term financial planning, right? However, trying to find what the good mix is, like that becomes the question that, you have to kind of speak to your financial advisor about and figure out, what is the most ideal solution for you, right? So with that, I think, we'd like to obviously thank you for attending. And, I think the Q&A session is probably the session that is hopefully will be the one that most attendees get the most out of. So
Yeah.
Shamil?
Yeah, absolutely. And we have a lot of questions here. So Nadeem, just brace yourself and we'll go one by one. So one of the first questions is there a designated retirement age in Canada?
Well, not necessarily. However, with the RSP account, when you turn 65, right, you do have an option of taking your RSP account and converting that to what's called a retirement, a registered retirement income fund. However, you can even defer that. You can say, you know what, I'm not gonna withdraw from my RSP right now because I'm still working. But definitely at the age of 71, you have to now start withdrawing from your RSP. And it starts off like roughly at about 5.5% of the value of your of your RSP account. So I know we didn't cover this in this, and maybe we'll cover this in the next webinar, where what happens when your RSP now becomes a fund that you can start withdrawing income from. So the quick answer is, I don't believe there's a set age where, you're forced to retire, but there is a set age where you have to start withdrawing from your RSP, and that is 71 is actually the max.
Perfect. Perfect. The next question is, what is the process of transferring money from RRSP to the TFSA, and will there be any taxes applied in the process?
Yes. So when you are withdrawing from your RSP, whether you're withdrawing from your RSP and just, taking it at cash and, spending it, wherever you want, or even if you're just moving your funds from your RSP to your tax-free savings account, you're withdrawing from a registered retirement savings plan. And so there will be tax consequences off the bat. Depending on how much you withdraw, there will be a withholding tax of anywhere from, it could be anywhere from 10 to 25%. So in other words, if you withdraw, say 5,000, the government's going to withhold $500. So you're only going to get, say 4,500 of that 5,000, right? So, not to get into specifics, but number one, there's that, the fact that there's a withholding tax. And number two, what ends up happening is the amount that you've withdrawn from your RSP, that goes on your income. And so you're going to, once again, get taxed on that.
Perfect. So the next question has to do with tax sheltered compounding. How does this money increase? Is it by investment in haram avenues?
Well, that's what ShariaPortfolio is all about, right? Is that we want to give Muslim Canadians a halal option for their RSPs and their TFSAs and really their overall financial planning, right? So, what we do is, if you, I guess you never, must be your first webinar. So what we do is the investments that we use have been screened through a Sharia screen. We follow the IOFI standard. And the difference between us and say a bank here is this. When you walk into your bank, the financial advisor there is going to say, okay, what's your objective, your time horizon, et cetera, et cetera. Great. And ultimately he provides you with a recommendation or a solution. That's going to be a fund or some type of investment. That investment is either going to be riba, or it's going to be a fund that owns haram, that probably has, a good portion invested in haram stocks or whatever. What we do here at Sharia is this. We go through the process of figuring out what your objectives are and everything, but ultimately the funds that the investment solutions that we are recommending have actually been screened through a Sharia compliance standard. So number one, we don't invest in riba. Number two is the funds and the stocks that we use have to pass a Sharia screen, which we follow as IOFI. And, and that's how we build our portfolios. So that money essentially is growing compounded, but we're doing it in a halal way.
Perfect. The next question is kind of the similar type of question, and it says, "Can you clarify how money grows in a halal way?" But I think you kind of just answered that. Did you have anything to add on to that?
Yeah, so I'll add something onto that, right? So I mean, so the perfect example to explain to answer this question here is this. Um, Again, if you're at a bank, they probably put you in, say, a equity growth fund, for example. That fund will have maybe some casino stocks in there, alcohol stocks, and some sin related companies in there, right? They have maybe 200 companies. In our case, what we do is we use a fund called the SP. It's an SP funds. It's the symbol is SPUS, and basically what we've done is we've taken the stocks in the S&P 500. We've applied our Sharia standard onto it, so we've eliminated all the sinful stocks, and we've also eliminated the companies that don't meet some of the financial ratios that have been set by the Sharia scholars. And ultimately, we put that into a fund. That fund now is what we consider to be Sharia compliant, and we monitor that fund on a monthly basis to make sure that it's rebalanced. So to answer your question is through an example, and that's the example that I'll give you is that, so this is an example of a fund and investment solution that we use to grow that money in a halal way.
Perfect. The next question we have is it true that tax might be applied if someone is an active trader within the TFSA account?
So that's a good question. I know that there's a lot of day trading going on, and people are using the TFSA account, quite aggressively. I would, first of all, I would suggest you speak to your tax specialist about that. With us here at ShariaPortfolio, that's not what we do. We don't day trade. We're more long-term investors. We will buy, we will hold, and yes, at times we will sell. But our intention is not to buy something today and sell it tomorrow or the next week, right? And really, from whether it's from a tax perspective or otherwise, that's not something that we would encourage. But I'm pretty sure the CRA does not look at that practice in a positive way. And one thing I do know is that the CRA, the IRS, eventually they'll get their way. So if it seems like you've been abusing the TFSA, I do believe that that's something that could be penalized. But I would check with your tax advisor for an official opinion on that.
Perfect. The next question we have is that if I've accumulated 50,000 in my TFSA, can I invest it all this year?
Absolutely, yes. That's an easy one. So yeah, so like I said, and the best way to do that is either go to your CRA profile and figure out what your that limit is for you, and if you have the money and you can do it in 1 year, absolutely.
The next question is, what vehicles do you normally use for investment that make them Sharia compliant? I'm assuming it's after the TFSA and RRSP like we discussed. Yeah.
So at ShariaPortfolio, we have two types of offerings. We have the Express service, which is basically an economical solution, especially for new investors. But in that solution, we are just using exchange traded funds, so ETFs, and we have a variety of portfolios, anywhere from conservative to aggressive. And in that case, what we are using our ETFs by our sister company. So the equity fund, which is the symbol is SPUS. We have a fixed income fund, which is a Sukuk-based fund that tracks the Dow Jones Sukuk Index. And the third fund that we are currently using is the real estate fund, which we recently launched that I mentioned earlier. So that's the Express. The Access service, which is something for our, you could say, our more experienced investors, where the minimum amount for that is 100,000. We are actually using, some ETFs, but also I would say a majority of individual stocks. So we're actively, buying companies and stocks that fit into the portfolio for whatever objective that portfolio is. So for example, if it's growth, we're obviously trying to focus on growth companies. If it's in our income portfolio, then yes, we're looking more for companies that are have a dividend and fit that bill.
Perfect. The next question is, if I put my money into a TFSA, will my income tax bracket lower like it does in the RRSP?
So no, it does not. So as I explained earlier, that's one of the disadvantages of the TFSA is that it does not give you any tax credit or lower your income.
Perfect. If someone has an RRSP account with a personal bank, can they invest with you guys? And what is the best process to begin starting with ShariaPortfolio?
Okay, so that's a great answer. That's a great question. And yes, you can. In fact, that's actually how we've been getting most of our clients is from other banks. And what I would suggest is if you go onto our website, www.shariaportfolio.ca, on the top right corner, there's going to be a Get Started button. And in that Get Started button, there's probably going to be a drop down that has our questionnaire. Click onto that questionnaire and enter your information. Once you enter your information, we'll have it in our system, and somebody will reach out to you, inshallah, to open the account and transfer it over.
Yeah, and I can put our link in the chat below in just a minute here, so that should make it a little bit easier as well. One interesting question which really confused me back in the day would be, what's the difference between a lira and an RRSP?
So a lira is what's called a locked-in registered account, and typically what that is in a lot of cases, it's if you've worked at a company that had a registered plan and you left that company and now you're no longer with them, you're at somewhere else, and you want to bring that plan over, you can bring that plan over. However, you can't contribute to it like an RSP. However, the money still grows tax-free, like it still compounds tax-free. So the difference between the lira and the RSP is this: the lira is basically an old employer plan that you are no longer with, and you are now you've transferred over to yourself, and we can, it's like self-managed. So we actually can help you manage that, or you can manage it yourself.
Perfect. The next question is, what's the typical return on investment with Sharia compliant products in percentage?
Well, I mean, that varies really. We have, we have a variety of portfolios where you have, conservative all the way up till aggressive. So there's conservative, there's income, there's moderate, there's growth, and then there's aggressive. So, and that all kind of goes back to how much risk, that investor has the ability and the willingness to take. Of course, the more risk you're going to take, the more expected return that is, and vice versa, right? But I mean, I would say, again, kind of using, using like a long-term average, like the S&P 500 has averaged about 9.9% over the past 90 years. Our fund SPUS did outperform the S&P 500 last year by quite a significant amount. Now we're not guaranteeing that that's going to happen every year, but even if, let's just say, we were to just meet the S&P 500, I would say the stock market itself has averaged about 9 to 10% on an annual basis. And then depending on your portfolio, how much of exposure you have to the market, that can vary, right? So it can go, for example, if you are only 50% in equities and you're 50% in, say, something like Sukuk, then you're going to be a little bit less than maybe, averaging a little bit less than 9 to 10%. But we also have other portfolio, like specific numbers. That's something that if you reach out to me and you email me, and if there were some specific numbers that you wanted, I'd be happy to provide them for you. But, it's kind of hard to do this through this session right now.
Perfect. Is there any value in someone in their 60s to invest in an RRSP now? In this case, the person does not have a pension.
I mean, if you're 60 years old and you're still working, and you have, and we I think we're in the process of actually putting up like an RSP calculator or something, right? But if from a tax perspective, if it makes sense, if you're 60 years old and you're still, let's just say, above average, especially if you're earning a high income, absolutely. You'll get that tax benefit. You'll put it into your retirement savings account. You don't have a pension plan, so you can still, accumulate. I mean, better late than never, I would say.
Perfect. What are the typical service charges with your portfolio?
So, so for the express service, which is kind of our, the economical solution that we have, The management fee for that is basically 0.5% of the value of the portfolio. And so that's an annual rate. So for example, if you had $10,000 to start and it was an express portfolio, if my math is correct, that would be $50 as an annual fee. However, we charge that over a span of 12 months. So that's express. The access service, which is kind of our higher end offering, so to speak, where the minimum is 100,000. That it's tiered pricing, so it actually starts. 1.5 would be the most that you would pay, and that's what we're charging right now. And it can go as low as 0.75%, depending on the value of the portfolio.
Perfect. The next question is, my spouse contributes through her Hoop account, and how can we see how much has been contributed to date, and how has the employer also contributed from their end, and is it halal?
So the first part of the question is something that I wouldn't be able to obviously answer. That's something that you would have to speak to Hoop about, or whoever is administering the plan, because they would have all the numbers as far as the contributions, what the plan is, and how much the employer contribution versus yourself, right? That's number one. Is it halal? Again, I'm going to go out on a limb here. Probably not, most likely not, for the simple reason that I don't know of any registered, I don't know any financial institution that is offering this on their retirement plan, meaning a halal Sharia option, right? So although I can't say for 100%, I can probably say for 99% that it is not halal.
Perfect. Do you invest in the Canadian market at all? And do you invest anywhere outside of the US markets?
Yeah, so the answer to that question both is yes and yes. Now, we primarily do that in our access service, which is where we actually add the individual stocks into the portfolio. We own some Canadian companies in a variety of portfolios, and I can kind of even give you some of the names that we own. Like, for example, in our growth portfolio, we have Shopify, we have Shopify, we have Canada Goose. In our income portfolios, we have Magna, we have Imperial Oil. Those are some of the Canadian companies, and we also have companies outside the U.S. as well. And those are more so, I would say, in our growth and aggressive portfolios, where we own a couple of Chinese companies and some European companies in that portfolio.
Okay, perfect. I think you touched on the next one a little bit, but if you have anything to follow up, it says, for high risk investments, what is the average rate of return for your portfolios? Maybe you can talk about last year's, if can you say that, or going forward, how you feel the markets are going to go?
Yeah, sure. I mean, we did do a year-end review webinar where we kind of reviewed our performance for the year. And our growth portfolios did do about 33, 35%. I think that's how we ended off the year. Alhamdulillah, we did outperform the market on that front. I would say, like I said, our growth portfolio averaged about 34%, and our aggressive was a little bit slightly higher than that, maybe close to about 37, 38.
Perfect. The next question is, if someone wants to transfer their funds from another bank to us, how would they make that transfer?
It's a good question. So, we have a team here where if you decide that, you'd like to move your account over to us, number one, either get in touch with myself or Shamil, to kind of get the ball rolling. The link there that I think, Shamil, if you want to post that, that'd be great. So that's just a get started link where you can put your information, you can put your contact information, and then our colleague in client services, she will inshallah get out to you and get the process started. So the only thing that we really need from you guys, outside of your driver's license and all that other stuff, is we would require just a statement of wherever your plan or your account is, whether it's at a bank or wherever. And you don't really have to tell your bank or wherever that your investments are, anything. We do it all for you. So we open the account, number one. So for example, if you're transferring an RRSP account, we would open up an RSP account here, and we would get your statement, we would get you to fill out a transfer form, and everything kind of comes over as is, and then we manage it for you, right, in a Sharia compliant way. So in other words, we're not withdrawing from your RSP. It's not like you're selling out of your RSP, you're taking your money and you're bringing it to ShariaPortfolio. No, you're opening an account at ShariaPortfolio, RSP, and we move it there. Likewise, if it was a TFSA, same thing. If the tax-free savings account is at the bank, we open a tax-free savings account here. We're just transferring everything from one tax-free to the other tax-free.
Perfect. Do you have plans for any other ETFs?
I think, inshallah, as our business grows, I don't see why not. I think, alhamdulillah, we've had good success with the first two that we launched, the equity and the sukuk, and which I think resulted in us launching the real estate fund. And I think, inshallah, as the company grows, as the interest and the demand grows by the community, then we will definitely, be looking to add more. But formally, I can't say that we have something in the pipeline, but I will say that as the company grows, I would say look forward to it. Perfect.
The next question is, can you explain the options for investing in real estate? I think they just want to know more about SPRE.
Sure. So the real estate fund that we have is not a private real estate per se. What it does is it invests into a basket of companies that are publicly listed. So they are trading on the stock exchanges. However, the underlying company is actually a real estate company. So unlike, I guess, for example, Apple is in the business of smartphones and whatever, AirPods and things, right? There are other companies out there that are specifically in the business of real estate, and their stocks are actually trading on the exchanges. So that's what we do. That's how we're investing in real estate, is still, again, through the public markets of the stock exchanges. But these are companies that are basically making their money on real estate. And the one thing that I'll say that's attractive about this is that, the fund is liquid. So unlike other real estate, where if you're buying into a particular fund and your funds are locked in for, say, 6 months or so, this is a fund that, you buy today. And our intention obviously is long-term, but if you, for whatever reason, if you need to sell it tomorrow, you can do so. So there's no, there's no lockup period on these funds.
Perfect. The next question is, how do I know if it's cost effective to purchase ETFs if there are withholding taxes?
So again, that's a good question. I think, what we try to do is, as financial advisors, we try to navigate through that. We understand that, there could be a withholding tax issue if that does happen. I would say this, when we're advising clients, right, tax is obviously a consideration, but it can't be the only consideration, right? In other words, what we're trying to do is build a diversified portfolio that can give you a return. And, of course, we do kind of factor taxes in, but we can't let that be the end all for it, in terms of decision making, right? So I guess the example that I'll give you here is this. Let's just say you have a tax-free savings account and you have an RSP. In this situation, right, what we try to do is we try to put the income generating security, like for example, the SPSK, which generates a US source of income, we try to put that and the SPRE in the RSP accounts, because in the RSP accounts, there's no withholding tax. However, in the tax-free savings account, yes, there's going to be a withholding tax. Now, for the SPUS, the 95% of its growth is actually coming from the capital appreciation. It does pay a little bit of a dividend, which is not bad. However, you're primarily investing into the fund for its growth, not for its income. And so I would say, the impact from a withholding tax, it's not significant enough for us to say, you know what, oh my God, we can't do this.
Okay, perfect. The next question is, and it's a little more technical, so you might have to answer a little more detail. If I want to retire in 5 years and my goal is to make at least $1,000 a month, how much would I need to save every month? I know it's hard to answer, but just a rough idea if you have one.
Yeah, well, I would say, yeah, that's a question that we would probably have to have a call on. because it's not, we'd have to kind of factor a lot of other things in. So I'm not going to attempt to answer that right now, but I'd be happy to answer that, or even Shamil, either of us can, have a call with you and kind of walk through this question and the discussion with you, inshallah.
The next question is, do you have a YouTube channel? The answer is yes, we do. ShariaPortfolio Canada, I think, on YouTube, so you can see it on there. What is the best stocks to hold? Sorry, which account is better for holding US stocks, RRSP or TFSA? I think you already touched on this though.
Yeah, so the only thing I'll just say is this. I mean, if the US stock does not pay any dividends, then, whether it's an RSP account or TFSA, from a tax perspective, doesn't really make a difference. However, if that stock is like a Johnson and Johnson, for example, right, that does pay a dividend, and if you had the option, okay, do I put it in my TFSA or do I put it in my RSP? You're better off putting that in your RSP, right? So, that's, what you typically, rule of thumb is this: if you got US stocks that are growth and don't pay a dividend, put them in your TFSA. Any US stock that is paying you a dividend, put that into your RSP account.
Perfect. Are there any halal options for group savings accounts through the workplace managed by companies like Manulife?
Unfortunately, right now, no. But I think as the demand grows, and if we, what I would probably tell anybody who, such as this brother or sister that's asked this question is this: go to your Manulife retirement planner, right? Whoever that administrator is, and demand it. I think demand ultimately will create that option. And I think as Manulife is actually one of the largest, if not the largest provider of group RSP plans in the country. So I think I would say, easily 10% of, their participants are maybe Muslim. And so in this case, if those 10%, or, even if it's 5, if they constantly demand this, I think at some point, they're going to have to, put that on their shelf, right? So that's my only friendly suggestion to you, is that go to your provider and demand it.
Perfect. We only have a couple more questions left. So the second last one here is, what products are recommended as Sharia compliant as the existing Canadian banks are not clear about it?
What products are recommended as Sharia compliant? At existing banks? Oh, I'm not too sure. I mean, I don't know. I can only tell you what Sharia compliant products are at ShariaPortfolio. I'm not sure. I'm not sure which bank you're banking with, but I will say this: it's not something that is internally promoted by the banks.
Okay. Another one here: if we withdraw money from a TFSA account, 24,000, for example, and want to contribute again, what is the maximum amount we could contribute if our maximum room is 18,000, for example, and we wanted to invest the 24,000?
Okay, so number one, when you withdraw from your TFSA, you cannot recontribute to your TFSA in the same year. You have to wait the next year. That's number one. Number two here is this: if I understand the question correctly, is if you first started and let's just say you deposited 18,000 and that was your limit, and that 18,000 grew to 24, and then you withdrew the 24. What's your limit now? Well, you can actually next year you can actually put 24 plus whatever the annual limit is, so in like 6,000 back into your TFSA. So I hope I've answered the question, but your limit, you start off at a limit, and that's your contribution limit. When the investment grows, the growth of that investment doesn't take away from your limit. In fact, if you decide to withdraw from it, then your new limit is actually the amount that you withdrew. If I can explain that correctly.
I know your voice must be a little sore now, but one last question here. Is it true that TFSA provides tax shelter to the capital gains and dividends, and RRSP is 100% taxable? So is it best to invest in TFSA?
So I think, That's the question that we're trying to answer is, what is best for you, right? So first of all, the TFSA, it does provide tax shelter for capital gains and some dividends. Again, the whole question of US dividends versus Canadian dividends. Canadian dividends are also, they have that tax shelter, and they have that tax benefit, but there is a little bit of a problem with the US dividends. However, so that's number one, right? The RRSP, it's only taxable when you take the money out. So there is still some tax benefit to investing into it, making that money grow. But at some point, you're right. The money that you take out is going to be taxed. See, the difference is when you put 10,000 into your TFSA, that 10,000 is after you've paid your taxes. When you put 10,000 into your RRSP, what ends up happening is the government takes that 10,000, reduces your income, so therefore you get that tax credit, right? So that's kind of the difference between the two, is that you've gotten a tax benefit from the RRSP, but when it comes time for you to take the money out, then they will get some of that back.
Yeah. Again, that's the end of the questions. So Nadeem's information is on the screen. The information is also in the chat if you guys ever have any more questions. Hopefully that was very informative. You got a lot out of it. And thank you so much for contributing with your questions. We love answering them. And did you have anything else to add, Nadeem, before we sign off?
Yeah, sure. Just again, just want to thank everybody for attending, and we obviously welcome the questions. And please do not hesitate to reach out to myself or Shamil, especially if you're in the West Coast area. Shamil, I know your information is not here, but if you do go onto our website, ShariaPortfolio.ca, and you click onto our team, you'll see the whole team. And the last thing that I will say is that if you are interested, if you're ready to take the next step to move your accounts over, please do go onto our website. Click on the Get Started button and include your information, and someone will be in touch with you shortly, inshallah.
Yeah, thank you guys again, and hope to talk to you at the next webinar in a couple of weeks here.
Thank you. All right, guys. Assalamu alaikum.